Welcome. In this video, we're going to discuss some of the numerous topics that we've talked about in this course and try and tie them all together. Specifically, that would include certain performance metrics such as return on investment, residual income, cost volume profit, topics that we've talked about that include break-even and operating leverage, issues of capacity management, and the issue of decision making. In order to do so, we're going to utilize this simple little problem here, where you have a company that has an investment of $800,000 in operating assets, has a corresponding fixed cost of $160,000 a year. At this level of capacity, the company can support sales of up to $5 million a year, and the company has a contribution margin ratio of 10%. Now, the problem asks us to expand upon this simple little table, and we're going to do far more than that. We're going to try to create as much information as we can utilizing everything that we've learned that's relevant to this problem in this course. Okay, so first off, in this row up here, sales in this table are going to be incremented by $100,000. Our contribution margin ratio is 10%, therefore our variable cost as a percentage of sales is 90%. We're told that the company has an investment in assets of $800,000, and that correlates to fixed costs of $160,000. So the relationship between fixed cost and our investment in assets, or average total assets, is 20%. Okay, let's begin with our initial level of sales, which is $4.5 million. At $4.5 million, we will have variable costs of $4,050,000. Contribution margin of $450,000. We have fixed costs of $160,000 that will allow us to calculate a net operating income of $190,000. So what we have right here is income statement information. Here we have our relevant balance sheet information. And now over here we can start to analyze that and calculate some of the various things that we've talked about. So first here we've calculated our operating leverage. As you will recall, operating leverage reflects the underlying cost structure that we're working with, the relationship of total fixed cost to total variable costs. Right here we have our operating margin. Our operating margin is defined as net income divided by sales, capital turnover. This is a measure right here. Operating margin is a measure of efficiency, and the way in which we would interpret that is for every dollar of sales that we're able to generate, we get to keep $6.44 cents. So this is a measure of how efficiently we're managing resources. This ratio here is my capital turnover ratio, and this is a ratio that measures how effectively we're utilizing our underlying asset base or our capacity. The way in which we would interpret this is for every dollar of asset I have invested, I'm able to turn that over 5.63 times, or generate $5.63 worth of sales. My return on investment here can be calculated two ways. It can be calculated directly by taking net income divided by average total assets, or it can be calculated indirectly by multiplying my operating margin times my capital turnover. We could also calculate our break-even in dollars. We would do that by dividing our fixed cost by our contribution margin ratio, and we can calculate our residual income. Residual income is a concept that expands upon the concept of a net income, except that we include a cost of capital. Now, in order to include that cost of capital, we need to know what our required rate of return is, or our weighted average cost of capital. That's not given in the problem, so I'm assuming that's 25%. So the way in which we would calculate residual income here would be to take our net operating income and subtract from that a capital charge, which would be our required rate of return times our investment in assets. And that gives us a residual income of $90,000. All right, so in this table, and then over here finally, we can measure our capacity. If we have a capacity for $5 million in sales and we're currently at $4.5 million, then we're operating at 90% capacity. All right, now let's start to increment sales. And we'll just assume for the sake of argument that this is happening on an annual basis. So this is my level of sales in year one. This is my level of sales in year two. So when I increase sales by $100,000, what's going to happen? Well, my contribution margin is going to increase by 10% of that, or $10,000. Because my fixed costs are not changing, my operating income is going to increase by that same $10,000. What's going to happen to my operating leverage? It's going to decrease. Why? Because my fixed costs are staying constant, whereas my variable costs are increasing. My operating margin over here is going to increase. You can see it's increasing. Now let's try to logically think that through and understand why that would be the case. Well, if my contribution margin ratio is 10%, what does that mean? That means for every dollar of sales that I generate, I get to keep 10 cents in contribution. And if my fixed costs don't change, then that means my net income will also, I get to keep 10 cents worth of net income. So my incremental operating margin is 10%. This can be thought of as an average, and the average will always follow the margin. So if my marginal operating margin is higher than my average operating margin, that marginal will pull up the average, which is in fact what's happening right here. My capital turnover likewise is increasing. That logically makes sense. Why? Because we're generating a greater level of sales, in this particular case $100,000 more, on the exact same asset base. Those two combined lead to an increase in my return on investment, and now that we've got 2 years to compare, we can see that we have an incremental return on investment of 1.25%. Obviously, my break-even is unaffected by this. It will not be affected or impacted until there is a change in my cost structure or my revenue structure. My residual income over here is increasing by $10,000 for every $100,000 increase in sales. So as we go through year 3, 4, 5, 6, we finally get up here to where we're operating at 100% of capacity. We have sales of $5 million. We have a corresponding total contribution of $500,000, corresponding net income $340,000. And now we're at a decision point. What do we do? We are completely maxed out. The only way we can continue to increase sales is to increase our capacity to go out and increase our underlying asset base. Now I'm going to assume that we increase capacity by 50%. I'm going to assume that this relationship right here is constant. Therefore, a 50% increase in assets would take us from $800,000 to $1.2 million investment in assets. Likewise, that would increase our fixed cost from $160,000 to $240,000. So what happens in the first period after making that increase in capacity? Well, my sales go up by $100,000, so I'm at $5.1 million. My contribution continues to go up. My net income has been pretty severely negatively impacted. Why is that? Well, let's look at this here in particular. What has happened to my contribution? That $100,000 increase in sales in this year, I've increased my contribution margin by $10,000, but in this given year, my fixed costs increased by $80,000. So that has a negative impact of $70,000 on my net income. My operating leverage has jumped up considerably, which makes sense because my cost structure is once again more heavily weighted towards fixed costs. My operating margin has been significantly negatively impacted, as has my capital turnover, and as has my return on investment and my residual income. They've been whacked pretty good. So you can start to see the problem here. What should happen from the standpoint of the company as a whole? Well, if we're able to continue to increase sales, again, we're just going to assume that we're able to increase sales by $100,000 every year for as long as we want, assuming we have the underlying capacity to support those sales, well, then what should we do? We should make that investment to increase capacity and work our way up towards this level of sales. And this corresponding level of contribution, this corresponding level of net income, so forth and so on. However, we have all kinds of different metrics over here that we're looking at. So that's what we should do from the standpoint of the company. That's pretty obvious. But what's likely to happen in terms of the actual person making the decision? Well, if this person makes the decision to increase capacity in this given year, it's going to have a tremendously negative impact on a lot of the different metrics over which that person would be evaluated, such as net income, return on investment, residual income, and if you wanted to drill down into, say, return on investment, operating margin, capital turnover, so forth and so on. So, bottom line, if this person has a short-term perspective, if they're not going to be around very long, they don't perceive they're going to be around very long, they're being evaluated by somebody who's going to look at their performance only in that period and not look at the bigger picture, then there's a high likelihood that they may be disinclined to make this investment, which, as we can see, assuming that we're going to be able to continue to grow our sales, which is an underlying assumption in this particular problem, as we can see, that's what we should be doing. If you'll remember, when we talked about capital budgeting, we talked about the accounting rate of return. I commented that there was nothing redeeming about that particular metric for making capital budgeting decisions. Once again, decision making should be based on a discounted cash flow analysis. However, accounting rate of return is essentially the same thing as return on investment. And if an individual is being evaluated based on return on investment, which is very, very often the case, then they're going to end up trying to maximize that particular metric, and they're going to make decisions in consequence of it. Okay, that's it.